Hello everyone, I'm Cody Koch. This is a question and answer series video, so let's get to it. It looks like interest rates could possibly go a lot higher. I'm curious, what would you do to buy businesses in a very high interest rate environment? So this person's referring to Iron Oak Capital, which is I'm a managing partner there and we acquire businesses. This is a great question. How exactly do you finance these deals in these kind of environments? I had a mentor who had acquired over 200 businesses in his day, and he had started buying business back in the 1960s, and he continued to buy businesses well into the 2000s. Had a lot of experience with this kind of stuff. Back in 1980, the Fed funds rates were, if I remember correctly, over 19%, like 19.5% or something like that. And so a lot of interest rates, bonds and such at that time were over 20%. Okay, so that's what the interest rates were in many cases. Mortgages were 20-something%. It was a really different time than what we have today. Back then, they didn't really have the SBA helping business buyers buy businesses. In fact, Ronald Reagan, who was president in the 80s, spent a great deal of time trying to actually close down the SBA because he thought it was a waste of time. Banks typically didn't want to do conventional loans on business acquisitions. I mean, they would loan on a line of credit or a piece of equipment or something like that, but at that time, it was very hard to get financing. Interest rates were high, it was tough to get the money, so how did they do that? Well, the answer is, in that kind of environment, typically the multiples that businesses sell for go down. In some cases, go down dramatically. Like, for example, today, you'll see a lot of multiples that may be 3 to 6 times earnings. In that kind of environment, we may have seen the same businesses go for 1 to 3 times earnings. That's how extreme it could be. One, the prices are lower, typically. The next is that buyers would go in and they would put a down payment. Let's say it's a purchase price $5 million. The buyer may go in and put down $1 million. And in that case, since they couldn't really get financing in any other way, in a lot of cases, the sellers would actually carry back the other $4 million. In other words, they would actually carry back 80% of the purchase price of the business, believe it or not. That environment did happen a lot. It's called seller financing. The sellers were willing to take losses on their interest income to compensate by charging lower interest rates than the prevailing rate. And so a lot of cases you see seller financing, they may do seller financing at no interest rate at all. Or if they did have an interest rate, it may be 9 or 10%, well below the prevailing 20% interest rate. High interest rates do is they just shift the market into another direction. So typically in a normal interest rate environment, outside of these high interest rate environments, financing a business acquisition is really one of 3 ways. You use equity, you use some kind of debt, and you use seller financing. But with a really high interest rate environment, typically you're going to use equity and you're going to use a lot of seller financing, and you may still use a little bit of debt, but it's going to have to be very carefully chosen simply because the interest rate on that debt is gigantic. So high interest rate environment simply just shifts how deals are done. They go from bank financing to more seller financing. We have very high multiples and a lot of bank financing. Back then it was much lower multiples with a lot of seller financing. And so it was a very different kind of structure and world to what we have today. So deals are still getting done. Everybody's still motivated. There's still got plenty of sellers wanting to sell and plenty of buyers wanting to buy. It's just the prices and the deal terms change significantly with the high interest rate environment. If this was interesting, please click the like button and subscribe, and I thank you for watching.